Now that we've covered federal student loans in detail, both for students and for parents, let's talk about private student loans. Private student loans are loans that are issued by a private financial institution like a bank or a credit union. While they can be issued directly to an individual, such as a student or a parent, many lenders prefer to have a cosigner on the loan so that they have a better chance of collecting payments. They are also based on the borrower's creditworthiness, meaning that income and credit history will determine how much, if any, the borrower can qualify for. They can have a fixed or variable interest rate, meaning that sometimes the interest rate can change over time. And they generally have strict repayment plans. Sometimes payments are due immediately after taking the loan, unlike federal loans, which usually start after the grace period after a student graduates. They also don't have flexible repayment plans, nor is there a formal program to consolidate loans like federal loans. And even though they are now private loans, they are extremely hard to discharge in bankruptcy. If you're considering refinancing federal loans into private loans, or are dealing with private loans right now, it will probably help to know what the differences are. Here's a quick comparison of federal and private loans. The lender. For federal loans, it's the federal government. For private, it's a private financial institution such as a bank or a credit union. The interest rate is fixed on federal loans, and it can be fixed or variable on private loans. Repayment usually starts after graduation versus payments might be due while still in school on private loans. Approval is based on need determined during the financial aid application process. Private loans only look at creditworthiness. Federal loans don't generally require a cosigner, but private loans usually do. And federal loans have numerous benefits, such as extended repayment plans, income-driven repayment plans, and loan forgiveness. None of these federal benefits apply to private loans. If you're struggling with private student loan payments, you do have some options. However, they vary widely depending on your lender. There are no set standards, so some lenders may offer programs and features that others do not. More and more private lenders, though, are offering a version of deferment and forbearance. The terms and eligibility can be far different than with federal loans, but if you're having trouble with payments, this may provide you with some temporary relief. Another option is to refinance a loan into a new private loan with more favorable or more affordable terms. You may be able to refinance into a new loan with your current lender, or you might be able to find a better loan by shopping around. As I mentioned, your credit and ability to borrow will determine whether this is an option for you or not. One of the most common options is to modify the existing loan. Private lenders want you to be able to stay current, and some offer various modification programs. Many programs will incorporate some form of these two modifications. First, an interest rate reduction. Some lenders may lower your interest rate, which will help you lower your monthly payment. By itself, a rate reduction may only lower the payment slightly, but in combination with extending the term of the loan, the payment might be much more affordable. If the lender extends the term of the loan, say from 5 years to 10 years, you'll have to make payments for longer, but the monthly payment amount should drop substantially. The only way to know for sure what your lender offers is to contact them directly, explain your situation, and evaluate the options they present.